Okay, now we start with the money management. I am assuming everybody is back. Now, a lot of people have misconception about what money management is. Some people think it's portfolio management. Some people think it is, where you keep your stock. Money management answers the question, how much? So basically, you have a certain amount of capital allocation. This is the business of capital allocation. Let's be clear. So money management tells you how much you should bet on each trade so that you survive long enough in the business that you are able to finally come out ahead. Like I explained earlier, only after 100 trades would you be able to say whether your system is profitable or not. Hence, your capital should last you long enough to make that assessment. Now the first principle I use, these are my principles. Okay, everybody constructs their own principles based on what is most important to them. Since I am a futures trader, risk of ruin is the most important question for me. Why? Because in futures trading, sometimes you can go bankrupt. So this is number one priority for me, to create a system which cannot go bankrupt. Okay, so I take a risk only of 1% per trade, and that ensures that if you have the edge, you'll be able to play long enough for that edge to play out. Now 1% for different people is different. A person having 5 crores, 1% is 5 lakh. Person having 5 lakh, 1% is 50,000. 5 lakh, sorry, 1% be 5,000. So you have to see, why shouldn't you do less than 1%? That is done by conservative people, which means they are under trading. You shouldn't overtrade. At the same time, once you know what to do, you should not under trade also. If you have a capital of 5 crore, you are taking a risk of 10,000 on every trade, then you are under trading. You will not get the results that you want. Now I will soon in the next slide prove that even if your winning rate is 50%, how much money you can make provided other things are right. You immediately have taken the stress out of your mind that you have to be right more than 50%. The third thing is that you need to ride winners 2 times of losers. That's not very difficult. At least 1.5, 2 times the loser, you can have those winners. Plus, once it starts winning, add to your winning trade. So, if you follow these 4 principles, chances are a modest system should work out. Now let's see what is the math of trading. Let's take a sample of 100 trades, 50 winners and 50 losers. The winning trade makes 40 points, loser takes 20 away. So the winning position is 8,000 shares, losing position is 4,000. So gross win is 1 crore 60 lakh, 50 winners, and gross loss is 40 lakh. Net you make 1 crore 20 lakh. So if anyone tells you that I have a 95% winning, ask him how much money you make. What did George Soros say? It does not matter how many times you win or lose. It matters how big a position you have when you are winning and how big a position you have when you are losing. Just go through this again. Sample of 100 trades, 50 winners, 50 losers. Winning trade makes 40 points, Loser takes 20 away. Winning position is 8,000 shares. Losing position is 4,000 shares. Gross win 1 crore 60 lakh. Gross loss 40 lakh. On a net basis, on a 50-50 system, you still take home 1 crore 20 lakh. Not bad. Success rate is not important. Often I see, several advisors, etc., talking about success rate. I have calculated my win rate over a period of time is about 58%. The other 42%, I try to reduce the damage. And half of the losing trades close at break even. So actual losing rate is about 20% because half the trades are turned around. Last year we made 300% on Bank Nifty. Winning trade is larger because you add to a winning trade. Both trades start at 4,000, but winning trades you add on, and I will show you how to add to a winning trade. But the idea is at the completion of both the trades, on one trade you add a larger position. The mechanics I will tell you, but this is the basic. In principle, your winning trade has to be larger. Break even is the loss gets covered and the trade is break even. Because it's losing no break even. Half of the trades can be turned around because the losers give you a certain message, and that will show you, how those trades are turned around. Now this is a sample money management that I had once upon a time. Say total liquid cash available for this business, and don't go by zeros. You can reduce 2 zeros and the same thing will apply. Just focus on the method. I have 5 crore of tradable capital. I divide it up into 10 stakes, which is 50 lakh each. So if you have 50 lakh, you divide it into 10 stakes, that's 5 lakhs each. Same thing. I tend to use one stake at a time. So at any given time, I like to have a capital of 50 lakh and which gets leveraged several times over. So basically on that 50 lakh, I am taking 1% of overall liquid cash as a risk. So I am taking a risk of 5 lakh on that 50 lakh stake. Because if I take a risk of 5,000 or 50,000, then I will be under trading compared to the 5 crore of capital. So the risk I take is 5 lakh. Maximum loss per trade on the Nifty is 100 points on the Bank Nifty. So if I take a long trade or short trade and moves 100 points against me, that is it, because most trades by definition should immediately start working. Maximum loss per day is 10 lakh and maximum loss per week is 30 lakh. So that is when my terminal is switched off. Then I don't trade any more trades. But up to 5 to 10 lakh, I can often come back if the markets give me good volatility. So here what I am taking care of, by dividing up into 10 stakes, I am making sure the market will have to kick me out 10 times to finish me. That doesn't usually happen. Okay, so that takes the fear of going bankrupt out. Next, this is what I do. This works for me. But on similar lines, you can make a system that takes care of your concerns. Now my average win is 5 lakh, average loss is 5 lakh. I am talking about average. I have big winning days also. So assume total 10 trades are taken in a month. Winning rate is 60%. In 6 trades, we make 30 lakh. In 4 trades, we are able to close 4 losing trades. We are able to close 2 at break even. So even if I assume an average of that, some trades are 10, 12 as you know. So net profit is 30 minus 10 is equal to 20 lakh per month, which is about 50% on total capital. So just by having a 50% win rate, by having the same winner to loser, you are able to get a 50% return on total capital. How? 20 lakh into 12 is 2 crore 40 lakh, and you have a total capital of 5 crore. On just your margin money, the return is 40% per month. So this is the kind of math I have in mind when I am going to trade. Uday is not able to see. See, a winning position, in my view, should be at least 80 to 100 points in your favor. Otherwise, it's considered neutral on a bank nifty. So on a normal stock, if something is moving strongly in your direction, it's giving you 2 or 3 green bars in your direction, that would be considered a winning trade. So a winner does not mean it moves 5 points from your break even. A winner basically means that it starts moving in the right direction and strongly. And that will show you what we mean by that. Okay, slide 19. Let's assume my average win is 5 lakh, average loss is 5 lakh. I take 10 trades in a month, winning rate is 60%. So in 6 trades, we make 30 lakh, 5 lakh each on 6 trades. In 4 losing trades, we are able to close 2 at break even. So 2 break even trades plus 2 losers. So the losing trades add up 10 lakh. Net profit is 30 minus 10 equal to 20. Now someone else can have an average winner of 10 lakh, but winning rate is only 50%. So even that math will work. So that is how things break even, and out of 4, generally 50% it's possible to do. I'll show you how. Risk of ruin, since I am primarily a futures trader, my money management takes care of that. Also, what is the benefit of having other businesses? Often people say, if you are such a successful trader, why are you advisor, this, that? Sir, every month one stake gets added back to my account by doing other things. It's no fun that I have to pay my electricity bill tomorrow, and for that I will trade bank nifty today. So if you have other things which are paying your bills, other things which keep you financially very comfortable, your decision making trading will be much better. Average winner or average losers are often similar in size because of the way I trade, because I try to take large profits, and hence sometimes things don't work out. But it's possible on certain in certain kinds of markets where in 5 7 days you do what you do generally in a month. So I'm just taking an average to keep things simple so that I'm not giving you an exaggerated view. Getting some monster winners to top up performance is extremely important because at some point or the other, you'll latch onto a big trend. So the idea should be to, if the market is kind, probably make money worth 3 trades in one trade. So here till now, no strategy, nothing. But if these things are taken care of, the odds of making money go up significantly, and the odds of surviving in this business increase exponentially. If you survive in this business, finally you will thrive. Now, what kind of a trading plan works out? A trading plan is a trader's business plan. So, it should have what kind of capital are you willing to deploy? What is the sort of risk per trade you want to take? What sort of instrument you want to trade? Is it bank nifty? Is it individual stocks? Generally speaking, people who specialize in one instrument do much better than all rounders who try to dabble into everything. Time frames. While trading multiple time frames could look like diversification, but specialization works in trading. So my recommendation is take one time frame and become a master of that. Now, what is the trade setup? What are the events you are going to look for to enter long or short positions? What is the entry trigger? You enter above the high, below the low, etc., etc. All this has to be very clear and in writing so that there is no scope for second guessing. What is the initial stop? Where do you add? How do you change your trailing stop? What is the exit plan? What are the tools you are going to use, as in moving average, etc.? What is the emotional and psychological preparedness? Right? You should have some sense of what you are going to do, where you are going to do when you come into trade. Just coming in and asking how many kya banaya, that's not the way you do things. Record keeping, outcomes, analysis of your trades every day. Go back home, like Imran said. Go back home, see why you lost money, why you made money, what happened, what was your planning, what didn't work out, what can be improved, that way. Now, what is my trading plan for Bank Nifty? My first job is to assess whether a market is sideways or trending, which means either trending or range bound. So, we'll tell you how we get to that conclusion, but let's just go over what I look at. Either the market is trending or it's sideways. If it's ranged, I want to figure out the bounds. Very simple. If it's a ranging market, in a sideways market, you'll have the lower boundary and the upper boundary. If it's trending, we look for places where we could buy intraday dips or rallies to act. And that is done through pivots by us, and pivot theory we'll go through tomorrow. Then there are locations. What sort of location would you put your buy trades on? If you have everything in writing. The moment prices get there, you are ready to act, because when you get one location, you go back and see whether that is a really significant location where in the past also things have held on. Look for the right candle setups and these locations. Look for approximate targets. Pivots gives you targets also, and try to match them with some previous action which took place at those points. All of this should be part of pre-preparation. What is pre-preparation? It's like an army conducting exercises which are very real life and battle oriented, but when you go to actual battle, you are not sitting there making plans. Okay. So each and every level of detail should be there in your trading plan. Another quiz: what is the most important aspect of the three? Or rather, the order of importance. By the end of tomorrow, I would think most of you will be able to make a trading plan, will be able to fill up the blanks in the trading plan format that is given to you, and it should be very crystal clear. That basically is your list, and everything is driven by that list, not by what you feel. By de-emphasizing entry, I am trying to raise the awareness and importance of other things, because most of us start our trading career watching TV, and on TV they discuss the least important issue. That is why TV traders are not successful. This was a section. Now let's get on to the important section, which is the real thing that everybody is waiting for. So now all housekeeping is over. Now we get to okay. Now a lot of people have asked me why I trade Bank Nifty so much, because in India my experience is that Bank Nifty gives me reasonable amount of liquidity. If you try to do 5, 7, 10,000 shares in most individual stocks other than a few large ones, you will move the price by 4 or 5 rupees. And in intraday trading, 4 to 5 bucks is a lot of money. So the good thing with Bank Nifty is that once you are right, you are able to make 150 to 200 points. It moves fast and it gives you large moves. As a trader, I want volatility, liquidity. In my experience, individual stocks don't tend to do that. That is just my experience. There is nothing wrong with trading the index or individual stocks. Every person has their own niche, and we will tell you how to do both of these things so that there is no confusion. Okay, now just show me a show of hands. How many people are totally new to any sort of technical analysis? Just say, just type new in your feed so that I know what is the level of the group and where should I start from. Okay, so there are enough people who are new. So people who know a little bit, please bear with me because everybody needs to get to some basic level before we can move on to a more advanced level. Nothing fancy. This is no technical analysis course, but just a basic understanding of what are candlestick bars, etc. Sure. इसमें कलर बार कहाँ से है? कलर पेन width
Pen size increases. Pen size increases.
okay.
इसकी
See, stock prices are often shown by candlesticks. Okay. Generally, the color that is used is for a bullish bar is green. The price is opened at the lower level, ended up at the higher level, and a bearish bar, the same thing, the price is opened at higher level, closed at lower level. You have other types of candles with other types of bars, but the best representation, just by seeing the bar, you should be able to tell whether the bulls won or the bears won. So this is as far as the open and close is concerned. Often you will have low which is extending lower, this is called a shadow, and high which is extending higher than the close. So this is what a candlestick bar looks like. Okay, so open, close, low, high, open, close, high, low. Okay. This is what a candlestick chart looks like, which is a collection of red and green candles. So if you just, nothing else, you just know red is bearish, green is bullish. So this is a bearish phase. Okay, this is a bullish phase. Basically, what you can notice that if you have red starting once, the red is repeated by red, more red, more red. So what is the odds of a candle being the same color once red or green starts? I think the odds are very high that the next candle will also be of the same color. Not all the time, but odds are high. So this is a message you can get from the candlestick chart, right? Now, what are the different sorts of candles which are important to our form of analysis? Otherwise, if you go through books, there are all kinds of patterns. I think more than 100 patterns. You don't need to know that. This is a big bar. What does it show? And what is it in comparison to? If the last 20 bars are, yeah, okay. Okay, इसमें और कलर का है
इसमें चार
हैं?
इसमें एक रेड
So basically, if you have 20 such bars, say blue can be here represented by the bullish candles. So after this, if you get this sort of a big green bar and it clears all the data to the left, chances of continuation are very high. So big bar means the bigger the bar, the more its significance. The smaller the bar, the less its significance. So these are the four bullish bars that you need to hunt. And we will show you certain combinations also which will make your life easy. Now, what happens here is that I'll show you how these are bullish. Okay, first issue is that You have a green bar, bullish, right? Bulls came in, but here and took the prices up. Then what? We have a bearish bar, but at lows, bulls came back and cleaned up the bearishness. So, who's winning? More than 50%, the bulls start winning. The bulls cleaned out more than 50% of this bar and hence it became a bullish bar. Now, bulls could also have done this, that they cleaned it out 100% and finally this bar became this. So in both cases, whether you have a small red body, this is called a body and this is called a shadow, with a black shadow, or whether you have green with a black shadow, both are bullish. Why? Because bears tried to take it lower. In this case, they were able to, the bulls came back and they were able to close it higher. In this case, bears were winning initially, but bulls came back and finally only a small piece of red was left. Okay, in another case, what will happen is that the close will be almost equal to the high. So there is no color, but all of these are equally bullish. Other than the fact, in this case, you probably don't need confirmation as much as you need here. Here, buying above the high is still relevant. But in this case, just closing in the green, I think it can be bought if the location is proper. And that we'll talk about. But these are the 4 bullish bars that we are interested in, not the hundreds of others that you will read about in books. Okay. Similarly with bearish bars, red bar, this was initially a red bar. Okay. Finally, this was initially a green bar. And finally the green got cleaned up and the market closed here on this bar. So that means the bears won the day. Again, bulls tried to take it higher, but bears came so strongly that they were able to close it in the red. So this is even more bearish than this one. This one needs confirmation, which the low needs to break. And this are almost equal. So this is how bearish bars play out. I look at everything as, are the bulls winning or are the bears winning? You must have heard it. So don't get volume shalom inside the play. First focus on what I am doing. And I don't do options. So for me, instrument is neutral. I look at the chart. You are free to buy option, future, stock, whatever you want. But don't try to confuse these issues, because I am instrument neutral. Now, what are the preconditions that you want in case you are looking to increase the odds. So what do I mean by big decline? If I am trading intraday, so what am I looking for? I am looking for a previous day where going into the close there is a strong decline. This could be stock, index, whatever. And next morning, what I want is that there is a big green bar. I am representing this by white, but I actually mean a big green bar. Because people are short here, my risk reward of this long trade improves. And I'll show you several examples. Last couple of days, you must have seen my two calls, Avanti Feed and Thirumalai Chemical. Now those were done on a daily chart, but just to prove that everything is instrument neutral, time frame neutral, everything applies in all conditions. Let me show you the chart of Thirumalai and Avanti Feed and tell you what I saw. Now look at this one. Can you see this sort of decline? How much lower are we from the 200? This is daily chart, but since everything applies to everything, look at this vertical decline. We gave this Avanti Feed call at about 1450. That was the place where this last red bar got cleaned out. And after that, it ran up to almost 1900. So we bought this because of that significant decline, because the distance between the 200-day moving average, which is this red line, and this blue line became very large, and the distance between this blue line, which is 20-day moving average, and the price became too large. So this is one of the parameters where you see how something is become way oversold, and we were just waiting for one green bar to appear. Now you can't say this is a green bar. This is a very small green bar that has no significance. But once this started to become a large green bar, put a stop underneath and you bought. This was a high odds trade. Okay. So where the precondition is that when you get a plunge or you get a big spike, you are looking to take the other side because your odds are in your favor. Similarly, let me go with Avanti Feed. Somebody is asking me, how do you find things during market hour? That means you sleep post market hour. I think the best way to trade is to come prepared with stocks which have plunged and have your 10 stock list and just attack the moment things start to move. If you are planning to hunt for stocks during market hours, good luck to you. you will not make it. Again, big plunge. What happened here? Red bar, the moment it got cleaned up more than 50%, around 1350, 1370 was where I suggested. And immediately it went up to the 20 DMA. Again, look at the distance of 200 from 20 and the price from the 20. So both these things showed that things are way overbought, oversold. So taking this trade with a stop below the low was a worthwhile trade. This is called counter trend trade. The trend was down, but we took the counter trend trading on the upside. See, a lot of you are asking questions, but my advice is please hear me out. A lot of answers you will get. But if you become too engrossed in questioning, then you will not understand the material. So just relax and understand. All questions will be answered. But I cannot go off track answering different questions. So that's how this is called a big decline. Similar thing could have been done with a big rally. Look at this one. This is a big rally. This green bar started to get cleaned out. Where? Can you see this previous? This is one high. This is high number 2. So you got your location, you got a big spike. Now you are telling me how do you find during market hours? Why you want to find during market hours? When this bar starts to happen, a lot of technical analysts will give you buy. But if you are vigilant, you see there is a significant high around the same level. So you are waiting like a sniper, and the moment you start seeing red, you take that other side. Okay. So I will give you many such locations. Just let me go through the presentation. Again, low. If you are vigilant and if you are not tracking 5,000 stocks, I think you will see the 200 plus a previous low. So you are ready to attack. You get your big bar and it moves in your direction. Right? So that's how swings can be traded even when the market is sideways. This is a sideways market. So what are we trying to do? We are trying to trade the boundaries. For the investor, the stock has done nothing. For the trader, he should be able to isolate such swings. Okay. Okay, what is next? Range breakout, breakdown. And see, if I tell you something can happen on the upside, exact same can happen on the downside also. See, you have some sort of range. As you can tell, it's a narrow range. Now suddenly, because of some news or something, what happens? You get this big large bar which takes out entire data on the left hand side, say 20 bars. Okay. Where is your stop? Below the range. Again, we will discuss locations, but I am just telling you that if you get this kind of a precondition, again, Can you see this on the previous day? Yes, because the current day's bar is here. So you have to come prepared with these sort of setups. What is the theory of narrow range? In the market, volatility alternates. Low volatility leads to high volatility, and high volatility leads to low volatility. I know there is a lag. You have to bear with me because so many softwares running on a single computer, they tend to misfunction. Because all of these financial softwares have some problem or the other that they can't put on the same computer. But the concept is important, not the lag. And I think I'm waiting long enough for everybody to see everything. So just focus. So this is the condition number 2. Same thing on the downside. If the range breaks down and entire data is clear to the left, say up to 20 bars, chances are you will get follow through. Again, wait for the high to be taken out. Why? Because sometimes just following one bar can lead to the price retreating back into the range. So follow through is important when you are dealing with ranges. Similarly here, it can go back and get back into the range. So just wait for the next 5-minute bar to start showing you follow through. And what is the third condition? Third condition is change of trend. Okay, so change of trend can happen if the market is coming down. This is the 20-day moving average. One sec. And this is the 20-day moving average. Suddenly what happens is the price starts to move above the average. Okay, it comes back down and it stops at the average and then starts to go up. This is how trend changes often happen, where prices are coming off, suddenly they cross the 20-day moving average and start to hold the 20-day moving average. Now we all know that in moving averages, if prices are held by a moving average like here, there is a downtrend. If the 20-day moving average is trending down, chances are price in a trend, and if the price starts to get held by a 20, chances are trend has changed and is now likely to trend on the upside. Tell me you understand this. Moving averages represent a trending market. Okay, if moving averages is moving lower, chances are prices are trending lower. But what happens if moving average starts to hold the price on the other side? That means a trend on the other side. Sir, entry, stop loss, etc. I will go through several examples. First, understand in principle. These are the preconditions. So, what do you look for day before? What you are looking for day before is a stock where the previous day the average has been crossed on the upside. So next day what you are watching for is, does the 20-day moving average get held? If that happens, you are ready to act and you get such strong high because people went short as the prices came down. And once this happens, all these bears become bulls and they have to cover. These are the three preconditions which increase the odds of successful trade in all time frames. So even if you go into a swing time frame, which is a multi-day time frame, if you act after these preconditions, you will be more successful. Just let me get through some of the stuff and then we'll talk about all your questions. Okay. Now let me explain some of the ways in which markets move and how trade management can be included in the subject. Now I hope moving average is clear to everybody. Generally the best moving averages to use is 8, 20 and 200. Although I sometimes use 50 also. But different trends evolve is that either you have a power trend where the 8 period moving average is held. This kind of a trend does not have big oscillations. It just keeps moving higher. Okay, so 8 is holding the price and this is the moving average that you need to use as a stop. At other times, the prices are not respecting 8 but are going that way and are holding the 20. In this case, the 20 becomes your stop. There is no standard stop. You have to see which moving average is being respected by the price. Because if the trend is strong, 8 will be respected. If the trend is not as strong, it will give you oscillations and the price is held by the 20. So first issue is we figure out which moving average is respected by the price, and that will only happen once the trend continues. Okay, now generally people think that stops are about if a particular price is held, is violated once, the stop is activated. Generally what happens is because everybody knows where people put stops, you will often see that price will hit your stop and run back up sharply. So my advice is if you are putting moving average as a stop, the price goes below moving average and cuts and comes back above, wait for another violation of this low for your stop to be hit. This is called a 2-bar stop. Otherwise what will happen, a lot of time your good trades will get cut because the 1 bar never fulfills its mission of follow through. There may or may not be follow through with 1 bar breakout or with 1 bar stop. So that you have to keep in mind. The idea of stops is to stay in the trend. It is not to get out of good trends. The other stop method that you can use is like in this chart. You get a climatic decline. Second day, the price first goes down and then it sharply turns around and starts to move up. So this red bar got cleaned up by this green bar. So you put a stop below the low. Once it starts to move, comes back, this correction is much shallower than this bar, right? Very easy to understand. Because it is shallower, now your stop moves here. A lot of you wanted to know where to add. Once you have a shallow correction and you get a big bar, add. Again price goes up, starts moving back above this pivot, increase your stop. Where do you increase? When do you update your stop? When the price makes a fresh high. So once this bar is complete, your stop comes here. Once another bar takes out the pivot, your stop gets here. Then the next stop is here. What you can also do is have the incremental approach. See, only novice traders, they buy all their position at one go. The smart trader will buy 2000 here. Watch it go up. As it comes off, buys another 2000. As this corrects, buys another 2000. Once you get this sharp rally, cuts 3000. Okay, maybe adds back some 1000. Again you get a sharp rally almost to the close, gets out entirely. So always be an incremental buyer and incremental seller. In fact, sometimes I get out 1000 on each of these green bars. That gives you a much better price rather than getting into everything all at once and not getting in and not exiting all at once. So exit incrementally, enter incrementally, that gives you much better risk reward. As I told you, this green bar, no follow through above the 5-minute bar, and finally you see it came off and collapsed. So wherever in these big green bars you don't have follow through, often you will see the entire trend reverse. Now what happened here? Big green bar did not get cleaned out by one red bar, but got cleaned out by several red bars. So that tells you that there are several ways this thing can play out. So now let's discuss what are the buy and sell events. Okay. Okay. This is big green bar. Cleaned out by big red bar. So what does this lead to? This basically, it makes your pin bar. This is equal to this. Right? So this is one event. Now both these should be large bars. Okay, and you need confirmation, which means breaking of the low. This is pattern 1. Second pattern is you have red bar cleaned out by green. What is this? This is bullish bar. Again, should cross the high. So, these two patterns are made of two bars, but they actually mean the same thing. Right? Now, sometimes what will happen is you have this green bar, but is slowly cleaned out by many red bars. Now the impact is the same as this one. This is also leads to a cleaning out of the green bar. Again, same thing. You can have a red bar which is cleaned out by several green bars. Look at it as a video game. Very clear. If you show it to anybody, they'll agree that this is the cleaning out of the red bar. Now here these bars can be, the small bars can be either red or green. So the import does not change even if two of these bars are red. As long as this red is cleaned out, the meaning is the same. So now you have pin bars, you have big bar, you have these different, cleaning out of the green or cleaning out of the red. Everything means the same thing. So you have these 6 events that you can now act on as the start of the trend. So you have to identify these bars and we'll just talk about the locations. Is this clear, the buy and sell event? Okay, moving along. Now, what is the property of 220? Basically of moving averages. Now say this is the 20-day moving average. 20-day moving average is a short-term moving average. And what it does is, it is the most powerful when it is inclined. So any stock which is above the 20, a rising 20, should be assumed that it will correct and find support at the 20 and again resume its uptrend, and that assumption can be like that. This is the property of the 20. If the market is in a trend, it will rise uptrend. Similarly, if a market is in a downtrend, it will decline. And again, same thing will happen, that it will stop the price from rising and make it go back towards fresh lows. Okay. Number 2. If this 20 is flat, then chances are that it's a sideways market, and then you will have to do your boundary trading. A sideways market, the average will not hold. Now what is the indication that you are getting here? That if the average is holding, chances are trend is coming, and if the average is not holding, then you have to wait for the boundary. So it's important to look at these things from both angles. The second average is the 200. Now 200 is a large average and generally it's most powerful when it's flat. Why? Because generally the market swings on both sides of the 200. Now what it does is, 200 is a very strong average, and because it is a very strong average, one of the big setups is, if we come towards 200 and you buy here, putting in a stop, chances are the market will resume its rally. So this is a buy on dip market. If the price is above 200, we are dealing with the buy on dip market, and this support will hold on at least once, both on the downside, and if the prices are below the 200, it will hold on at least once while the prices are going up. See, it's like the wall in a video game. You must have seen, when the ball hits the wall, first time the wall is not broken. When it hits again, sometimes it is broken, but some more. The third time it is broken. So if the price rallies from here but starts to decline after a small rally, then chances are this time it will go through 200. Or If we are rallying and suddenly the price comes with a big bar, chances are market will rally very lightly and again go through this. So it's important to see how the corrections are taking place. Like I told you, corrections have to be shallow. So if you are in a rally, what you are looking for is a correction like this. If you are in a rally and you start correcting like then you do not buy this dip. It has to be a landing. It can't be a crash. If it's a crash, then even 200 will get taken out. So that's what intraday traders need to do. They identify a trend, they look for a chart where correction is shallow, and then they build their positions. We'll go through several examples, so nothing to worry. But these are basic tendencies of a moving average. Now what are the locations? This is a rising 20. The best location to buy is here. One second. Let's mark out some locations. This is location 1, just above 20. This is location 2, just below 20. This is location 3 at 20. This is location 4, way above 20. This is location 5, way below 20. Now, sometimes you have to take different levels of position. This is location 1, light position. Now, if your normal position is 6,000 shares, this is 2,000 shares. Location 3 at 20 is also a 2,000 share position. Location 2 below 20 is a medium position which can be 4,000. But this is location 5 which is heavy position. Where was Avanti Feed and Thirumalai Chemical? It was at location 5. So often you'll hear several technical analyst books etc. tell you that you should not buy below 20 or sell below 20. There are conditions of everything. If an average is moving up and the price comes down sharply below 20, this is a buying zone. Now what happens if the price goes till 20, stops here and again starts to come off? Only then the trend starts to reverse. But if the market is going up, the average is going up and you have a sharp reaction, this location 5 should be bought. Since location 5 is a buy, what is location 4? Location 4 is a sell, because how do you get to location 4? And once you start getting these vertical moves, you move to a bar by bar stop, because if you have 20 as a stop and your price is here, you will end up losing all of this. So often there are 3 market phases: intraday or swing or positional also. Whereas the first phase is the initiation phase, where things start to move up from the 200. Okay. This is your range bound action. Price starts to move up. Okay. This is initiation phase. Then finally you get to a ride phase where the stock price rides, and finally you get to a phase which is vertical, and here your stop changes from a moving average to a bar by bar stop, so that the moment one bar is looking down, you are out. We'll do several examples of this, so nothing to worry. Now, how do you make your stock list? Stock list is made by stocks which have enough liquidity, lot of movement, because if you are trying to trade something like NTPC, I don't think you'll be able to trade a whole lot. So the whole idea here is that you get into things which have good movement and where your preconditions are there. Okay. Often the best intraday stocks are also good trending stocks like Bajaj Finance or Bajaj Finserv, Reliance. These are in strong uptrend. So each time they dip, the tendency is for people to buy into them. Okay, now all of you want to know how to add. So let me give you a very specific method of adding. See, this is your range. Also, you can look at this as a big decline, but range or big decline, basically the shorts got positioned, so this is your precondition. Now next morning, market opened up, had a sell-off, came down, and what happened here? The 20 period average or on the 5-minute started to hold on and changing to the upside, right? चेंज क्यों नहीं हो रहा है? क्लियर नहीं हो रहा है? Okay, so you got in here, stop placement right here. Now what happened here? Green bar, then you had a pin bar, then you had couple of red bars. So the bears tried their luck, right? Finally, these two red bars got crossed by a green bar. So this is where you add. This is your initiation, ignition. This is about 30 minutes later. 5, 10, 15, 20, 25, 30. So in the morning, this bar did not get the follow through. So you waited and first buy signal was this one, because the 20 started getting held. Not only 20 held on, 200 was crossed, which is a major resistance. 2 red bars, and again you have follow through where you add. Okay. Again you move up, again red bar which got cleaned up here. So again add. Stop by the time moves here. Now you have a vertical set of green bars. Move to bar by bar stop, and somewhere here you are able to exit. If you start getting vertical moves, then chances are most of the move gets done in that vertical move. If you want, you can leave 25% in and maybe see if you get some more. But often if you get 5-6 bars in your direction, that is generally, that generally makes your day. Okay, again you had this big vertical decline at the end. So this is something that is visible the previous day. So this can be in your list. Once you start getting this green bar which crosses 20, 200, yesterday's close, above 5-minute bar you buy. And you start getting vertical. Sometimes this happens. So in this case, what do? Maybe add here, because it tried to push the market lower, could not. But once you start getting so many green bars, you get into bar by bar and somewhere here you exit. If you are getting this kind of run and you let it come against you, then nobody can help you. So if you start getting vertical bars, please take it off. If you get 5, 6, 7 of them, this is way overbought. It is way away from 20. 20 is way away from 200. So here you would be justifying taking everything off. But most of the time this does not happen. What often happens is that you get a more steady move. Now again, look at this sharp green bar. Now one thing very important to tell you, it's sometimes very easy to do things when the bars are stationary. But when the bars are moving, see, this is your green bar. It went up, it found some resistance at 200, came off, and this reaction was shallower than this low. So you have to wait for the first reaction of the bears to see that price is not going to go lower. Otherwise, a few of these things will go down and make fresh lows. Okay, so maybe you take an initial entry here and then wait and see what happens. So your ad comes here. Somewhere here you take some profit because you have price action to the left. Each time you get this spiky bar, take 25% off, take 25 off. As the bars are moving in your direction, there is no point selling here. Once they start to come off, you have to take profits as the bars are moving in your direction. Okay. See here, this phase is initiation. You can call it ORB or whatever you like. This is ride phase. this one here. And finally, in most charts, you will get this kind of exhaustion phase. So you enter near this initiation phase, you add and write the right phase, and finally you look to get this exhaustion phase. Okay. If you take 2 or 3 trades, 1 or 2, if they give you this, your day is made. One may not work or one may work only till here. That's fine. But the same thing needs to be repeated again and again. Now see what happened here. This was kind of sideways. Market opened up higher. You waited to see what bears do. Bears tried to take this market lower, but the 20 started to hold. So, initiate position. Here, what is your stop? Below 200. Why? Because it can come down till 200 and nothing will change. Once it starts to work, look at this. You have red bars, again follow through. So if in a trend, after 2 red bars, you again have a green bar, you add, and same on the other side. So this is where you add. Because the uptrend is continuing. Add. Now see what you are getting, vertical. So now some people may ask, why shouldn't I add here? Because if you add here, you are adding way too late. And a bit of swing take you out bar by bar, and it takes you out here. Again, because you have this kind of a move, expecting that it will go all day is a bit much. So basically all stock moves can be divided into 3 phases. What you can also do here is add the 8 period moving average. We haven't done that because it makes the chart messy, but you could have added the 8 period average, and that could have been used as a stop. That would also have taken you out here. Now this is 39. Again, what's happening here? This is change of trend. What I cannot emphasize, too much is buying this bar is not the greatest of trading ideas. Wait for it to go back. Wait for it to do this testing. If this is successful, that means bears cannot do what they did here. The problem with doing this is that it will fail a lot of times. And we can go and abuse the trainer, the pattern, this and that. Every pattern, the price action is important. That did the other side try to bring it down, and were they unsuccessful? By holding 200, they are showing that they have been unsuccessful. So I like to act here. So this is where we acted. Once this green bar was complete, this is my stop. Say assuming the trade immediately fails. What did we lose? This. And if it works, what are we making? How many bars? So when you are falling, so we are falling out of the basement. When we are gaining up to the 20th floor. Nobody has said that enter at 9:20. Enter when the bears or the bulls, when the other side fails to take it, lower or higher as the case. The time can be 9:20, it can be 45, it can be 50. You are watching this like a hawk. I want to know whether bears can take it back below this low. If they cannot, then I know that bears are weakening. There cannot be any set rules in terms of what time you should enter. The whole issue is, does this 200 hold on? Does it give way? And you will only know once bears try to push the market lower. Is that clear? So you took this position, you got your red bars, you added add as early as possible. Why? So that if it starts to work, it works on your entire position and it's close to your stop. Again, stop updated, somewhere here, take 25 off, comes down, stop updated, and here you should be out totally. It works on all charts, even monthly chart. In fact, you will see a lot of stocks, we will show you daily charts because the concept is the same. I showed you that daily chart of Thirumalai and Avanti feed. This is range. See the narrow bars here. You got green, then the red tried to push it lower. Was it successful? No. So your stop is here. Buy. Add. Sir, forget about daily chart or weekly chart. All charts are the same. Just listen to me. Understand the concept. It works all the time. You just take this timeline off. Nobody can tell what chart it is. Put a stop. Buy here. Add here. Stop updation. Stop updation. Again breaking out. If you want, you can add here, and it now gets into bar by bar. This is optional. If you want to add, but it clearly shows you initiation phase, we are going to do here. What is happening is that the bears are not trying to push the market lower. So here what you can do is, once you start to get follow through beyond 15 minutes, you can decide to buy. Generally speaking, within 15 minutes, the bears come and they try to push the market lower. So at least take an initial position so that not out totally. We go up, it comes off. Your stop was here. This starts to happen. See, this is red bar getting cleaned out by green. Green, red, green. Add. Stop updated here. Now what is happening? This 20 period average is beginning to hold price. So your stop moves here. And this is vertical run. So you start exiting. Don't often try to exit. This is too close to 100. Exit once you start to get these bars which are away from 200. Right? So that the stock has had a bit of a run. And also exit on bars which are away from 20, not near 20. So this is exit, this is exit. Now how far? Don't get into measurements. If it looks like you have two large bars, try to exit. Okay, now let's discuss the four things which are also called Fab 4. Why it's important? See, previous day was fairly narrow range day. Again, this is visible previous day. Now to see whether you are on the right side, four things should be on your favor. Yesterday closing price. $200, $20, and the previous day, say 2-3 hour range. If you are below these three things and there is no action here, chances of your stock working out increases. Why? Because there is no support here. So when you are trading these range breakout and breakdowns, look for things which have had a narrow range day. If this had action like that, then chances are this would have broken out and by afternoon would have gone back. So you need things which are clean here. Is that clear? Another example. Range bound. There is nothing here. Again, see, even here, what you can decide to do is wait for this bulls to try to take it higher and then see what happens. Initial position, if you want, you can take here. But this is your add. Add. And then this is where you start exiting. Stop here, comes down to this point, then here, then here. Okay, there are several stocks which have a range bound day every day. When they have a range bound day, chances are they come very close to 200. So 5 or 6 more pointers I will give you to increase the odds further in your favor. First pointer is Look at size of swing. Which side of the chart is the swing bigger? Is it bigger on the upside or is it bigger on the downside? See, this bar started from this position, right? It gapped down, but this is a big bar. So this swing is much greater than this swing. So automatically you know which direction to take. If you are taking a swing on the opposite side and you start getting a swing which is crossing this, then there is a problem. So these are signs you have to watch for. Again, the retracements have to be shallow. You cannot have stocks or the odds go down if you are getting big retracements. Now, what is big? Up till this point, the retracement is fine. If this starts to break and it starts going higher, then there's a problem. Generally, above yesterday's high is a problem. Okay. The other thing, look for the 50% rule to be followed. What is 50%? That means if you have a strong bear bar, this is the 50% zone. Your green bar, if it happens, it should not get beyond this 50%. In fact, this is the place where you take position because the counter trend move gets over at 50%. And that 50% works all the time, which means if the market was going up and it falls sharply to the low and say there is a 200 here, if you buy, your target will be at 50%. Why? Because this entire green got cancelled out. And now you should expect it will back and make new highs. If it was in such a strong trend, it would have stopped at 50%. Just general, price action tidbits that make it useful for you to assess that till when you need to stay in a rate. If you are talking on a daily chart and the previous week is a congestion, chances are we'll stop at that congestion and turn around. Opening range breakout. To make these early morning trades if, what is the way out? Till you have enough experience, take the 30-minute opening range, which happens after a narrow range day and near 200. We have tested this 85% of the time. If previous day is a narrow range and next day is an ORB with 30-minute ORB, it tends to work 85% of the time. And when it works, it gives you 4 to 5%. So again, this is preconditioned stuff. Basically, ORB is ORB. ORB tells you that whether there is follow through coming on the chart. See again, narrow range, bulls tried to open it higher, but bears came in. Finally, the ORB broke out on the upside. The stop, initial buy, add, take 25% off, sideways consolidation. Look at the swing. Is it a deep swing? Is it a shallow swing? Shallow swings lead to further upside. And then you start getting here because the end of day is coming. These are the learning objectives of trade management. This is a little quiz. Now we are ready for question and answer. Opening range breakout. Basically 30 minute, the initial 30 minutes, let the market trade. If the market trades above the 30-minute high, we assume it's going up. If it trades below the 30-minute low, we assume it is going down. But it needs to happen at the 200-day moving average, because if you people know a bit about pivots, the 200 period average is the intraday pivot. So if the market, after doing its up and down, it starts to push on one side, generally speaking, it tends to show follow through. See, for intraday trading, only last day's price action is relevant. And why? Because if last day you had, previous day you had low volatility, today you can assume, although stocks can have multiple days of volatility, but you can assume that today the odds of high volatility are higher. I think one previous day for intraday trading is enough. Zero dha charts I have seen, but I haven't found them very clear. I like to have a professional software, but to each his own. If you find them good for you. Basically, you should know what to do. You do not have to watch stocks randomly. You have to watch stocks, A, which have liquidity, B, where trading volume is good, and the stocks which move fast. And once after 3:30, you should have 2 hours of preparation time where you look for all of these preconditions and finally zero in on 10 charts which you would be watching like a hawk the next day. If you are going to look for setups after the market opens, you will never find anything. Okay. See, you can't do intraday trading with end of day software, so that you have to decide what trading you want to do. I am not clear what you mean price move between 20 and 200 SMA. We assume as sideways move. If 20 is flat and the price is moving on both sides of the 20, it is then in a sideways market. And 200 is a strong support. From the 200-day moving average, you should expect that the price is likely to move away from the average. See, basically, an average is a leash, the price is the dog. So whenever the dog moves too far away from the average, the leash will get back towards itself. The best times to trade are 9 to 11:30 or maybe 11 and 1:30 to 3:30. Why? Because you get better follow through during these times. Sir, I don't worry about sectors. Just a broad idea. Okay, consumer sector is doing well, FMCG is doing well, Bajaj Twins are doing well. So I'll make a list out of those stocks. If I expect the market to move up, I want stocks on the upside. Although stocks can go down also even while market is going up. But broadly what I'm looking for is volatility. See, if you get into too much sector analysis and stock specific and fundamental and that, then the system goes for a toss. See, the preconditions I have given you, three preconditions, plus I have given you, which are the stocks and sectors which are in flavor. Which are the stocks and sectors in flavor? I tell you every day. Bajaj Twins, Reliance, Avenue Supermart, there are hardly 10-12 stocks which are moving up. Similarly, there are 10-12 stocks which keep moving down. Things like Canfin Home, Raymond, Ajanta Pharma. So you have list on both sides. So if you are getting patterns on both sides, even that is a viable thing. Get 5 longs, 5 shorts. See, scanning software according to me is not the best idea because it is very difficult to program scanners. If you want, you can do that. But I have seen the human eye scanning is much better than machine scanning. See, the no-no while doing ORB is that people sometimes preempt which way the market is going to break, or they do ORB way away from the averages. So if you do that, you are planning to fail. Buyer seller is nonsense, it has no value. See, again, if on the entire market, if on the 5-minute chart, and we'll talk about that tomorrow because tomorrow is more index. Again, like stocks, if the market is rallying and suddenly one big green bar is cleaned out by one big red bar, obviously there's a problem. So that's how you find out that, okay, it looks like there's trouble ahead. So we try to get off the bus. Sir, ORB means that the price opens, trades for 30 minutes, and after 30 minutes it takes a direction, either breaks the 30-minute low or breaks the 30-minute high. Yes, you have to select a small group of stocks, and you need 10 stocks are very easily tracked. But if you track 500 stocks, you can't track them. So if you come prepared with proper preconditions and everything else that has been told, your odds of success will be good. You need just one stock to move 3-4% and you would have made enough money. The rest is all adding, volume, trade management, etc. Choosing of stock should be a minor activity. I use Falcon. Even you can use it. It's 50,000 per year, so not a big deal. Well, how much time to prepare, that's subjective, but it should be a matter of detail. It shouldn't be like casual preparation because it will hit you the next day. So be very thorough and spend at least 2 hours. Don't spend 6 hours because over analysis will lead to paralysis. As you have seen, I have not mentioned volume, I have not mentioned stochastic, I haven't mentioned RSI. My principle is simple. If I give you one watch, you will be able to tell me the time. If I give you 10 watches, you will never tell me the time. Have just few things to look at and either you make it or you don't make it. By having 10 things, your confirmation will not be higher. See, exact bottom you cannot find out, but like I showed you in Avanti Fade and Thirumalai, that if you are getting a big plunge on the downside, you have to wait for the first green bar to take the previous red bar out substantially. I have not found Spider Iris to be good enough for intraday. I tried it out. It does not have the same features as Falcon. I look at stocks which in general are volatile, and if you are in the market, you know which stocks move sharply. See, what time frame you choose depends on your personality. If you are a 2-3 day type trader, then 30-minute or 60-minute is your time frame. Same bars, same theory, same trade management, same pattern, same events. But if you are an intraday trader, then your time frame is 5-minute. So time frame is immaterial. You choose the size of the move you want, the size of your risk, etc., etc., etc. This works from 1 minute to 1 year. Preconditions are given in your manual. Please check out your manual. Either it is a big plunge or a big rally. And when I mean a rally, I mean a spike. There is a difference between rally is more gradual. Spike or a plunge are sharp. B, change of trend that 20 DMA or 20 period average starts to hold in one direction. And C, we find out. Precondition is change of trend, climatic action, and range breakout. So all these three things are very easily seen. What is core to this is that by choosing such stocks, you would be automatically getting into stocks which are oversold, overbought. Sir, you cannot define all this minimum percentage return, etc. If prices start to move away from averages, you start to take it off. Yes, madam, you have to open each and every chart to see, how the stock is behaving. I only add the concepts that I have told you. I do not mess up my chart. If you have 50 indicators, chances are you will fail. If you know what you are doing, one screen is enough. If you don't know what you are doing, then even 6 screens are useless. Just the event without location is useless. So if you are trying to buy, like I told you, way below the 20, same thing applies even on 200. Way below 200 is a buy for me. So make sure that location is oversold when you are trying to buy. 30-minute chart is not an intraday time frame according to me, but still if you want, how many bars will be there? In 6 hours, hardly 12 bars. So you will not get the same sort of trade management in that. There was the question is in Avanti feed, there was a bullish candlestick pattern, so it came on your radar. No, it was on my radar because it was plunging. The day it came on my radar, or rather on my list, is when it started making a green bar. Because I had prepared, I knew what's happening there. The moment it started to hit highs of the day, immediately I opened up the chart and we were ready to go. See, what you hear on television is all rubbish. Okay, if those guys knew what they were doing, they won't be busting their ass there. So don't tell me what you heard on television. Who knows how many shots are there? Nothing can tell you before the bar. If I have 10 red bars, obviously there are shots in the system. Well, learning all those patterns like wedge, triangle, etc. That used to work in Edward and Najee's time. It was volatile because by the time all this is made, and some people use it, good luck to them, but they use it more for a longer term time frame because these days I don't think intraday you'll get great amount of patterns. So just going by support resistance trading, this form of trading you can call it is either pivot trading, which is also a form of support resistance trading. That's a different form of trading. If things are conflicting, move to the next chart. Generally speaking, if you stay with one chart, there will be less confusion with the one time frame. If you see 5, 15, 20, 50, 60, it will be all a mess. Sir, put call ratio means nothing. If your put call ratio is say what 1.6, is it higher or lower than 1.5? Or is 1.7 the right put call ratio? So all this is nonsense which is used to fill up television with talk. Yes, exactly, you can do what has been told to you, but be an incrementalist. Don't be a lottery ticket player that you will go and buy one lottery for 5,000 shares, either it works or it doesn't. First, dip your toes. If it gives you follow through, add, again add, then get out incrementally. Do it like a process again and again and again. Bank Nifty will be discussed tomorrow. Sir, I don't know institutions trade or they don't trade because for me the candle is important. Who makes that candle is not so important. I have given you general times. 9 to 11 is a good time. 1:30 to 3:30 is a good time. The ORB for day trading is 30 minutes. If advanced strategies could make money, we won't be here. Since you have mentioned Biocon, look at the size of the bar on Biocon. Biocon probably has made a top for a while. See, false breakdown, false breakout. If you say a market has been declining and finally it makes one lower low and immediately reverses and starts running up, that is called a false breakdown. If a false breakdown happens after a decline, it tends to have much superior odds of working out. Similarly, after a big run on the upside, if you break out again to new highs and that fails, that is called a false breakout. But if every second day you are looking for false breakout, breakdown, then they will fail a lot more. So I don't set any target, because once you set a target, you will not take your loss. And say the stock moves up 5% and your target is 0.5, you will miss out on a big move. Do not decide your target. That's what I am saying. Till the stock is doing what it's supposed to do, stay in. Sir, I don't know algo theory, I know pivot theory. What you do with it is up to you. I think the best form of trading is trying to play fear and greed, which support and resistance trading does. Because you don't have to manage multiple positions, the system manages the multiple positions. If something is not working out, get out. If something is working out, add, update, stop, and keep going. See, how long does it take to become a good doctor, to become a good lawyer, to become an expert on anything? It takes a long time. But consistent profitability, given the guidance, mentorship, etc., you have these days, I don't think it should take you more than 2.5, 3 years. Making money is a 6 month job. Within 6 months, you will be net profitable. What I am talking about is consistency. And total mastery obviously takes longer. Anywhere you get follow through, which is either a bars high or an ORB, only then go ahead and buy. Do not buy because you see a bar. It can sometimes have follow through, sometimes not have follow through. See, physical stops will get hit because you will keep them at the most obvious places. So there is no harm in keeping a mental stop and following it. If you don't follow, even physical stop, you will change. See, results also we will touch tomorrow. News based trading, how that is done. So we have just started, just warming up. See, again, more than 50%, what you can do is start taking position. But often 75% upwards, you can be a bit more confident. Don't start taking position immediately at 50%. See, in Avanti feed, it was clear. You have 10, 15 down bars, even 50% would work. But if you have 3 down bars, then maybe you shouldn't be so early. So all of these questions that whether you take mental stop loss or physical stop loss, I think are stupid questions because I have just explained that the price can hit your stop and keep running back up. So mental stop when a second bar follow through comes in and then you exit is a much better way of placing stops. Similarly, trailing stop, common sense says you are watching the stop and just exit when the moving average tells you. By putting physical stops, your stops will get hit and you'll keep getting thrown out of good positions. See, trying to cover all at once is not a great strategy. What you should do is you should put pre-orders. So if you have to get out of something and stock is moving up, keep your exit orders every $5, $10. That is a nice way to exit. Okay, because if you exit a large quantity all at once, you'll make a red bar yourself because liquidity is limited. Professional trading is about pre-orders. You have an anticipated area where you can go and you should put your stops there. And if you are right, your order should come in automatically. The monthly webinar will be from 1st of July because there is a second workshop which happens next weekend in Delhi. There is no room for hedging wedging in intraday trading or in any sort of trading because hedging has a cost. Nothing is free. So your stops should do that job. Trades will fail, and that is part of life. As long as you know what you are doing, future or cash doesn't matter. Sir, you want to complicate your life by looking at wicks, open interest, put call, this, that, then please become a television anchor. I think enough questions answered. Let's start lunch and maybe we can reconvene at 2 o'clock. We are doing fairly well in terms of the material. After this, a last session where more examples will be done is there, and then we can have another round of question and answers. The answer for the quiz that you just had is this one. See, in my experience, if you are right about the trend, gaps will often be in your favor. If you have not traded properly, only then you will get gaps against you. No, monthly workshop starts from 1st of July. The entry should be taken after there is follow up of a big bar, follow through, or with a 30-minute ORB. Sir, what else you want to watch? Option seller, buyer. That is all up to you. I think if you are right about the trend, everything will work out in your favor. If you are right about section, if you are shooting in the dark, then even option seller buyer can get flummoxed. Event trading I will explain tomorrow. Now we convene for lunch and reconvene at 2 o'clock. There are more examples ahead. We will again, start with the same thing. There are only examples now from here. So a lot of other things will get cleared up. Then we have a Q&A. So let's get on to that because there's no end to general discussion. 2 o'clock we will reconvene. So please enjoy your lunch.